Hi everyone, thanks for watching this webcast. I think it'll be helpful just to hear some of my comments over top of some of the slides that we didn't have a chance to go through on Saturday, but I think these slides are going to help you as you start filling in your financial statement summary template and as you begin familiarizing yourself with the financial statements related to the company that you selected. So I wanted to touch on a few high points, and this will be especially useful to people who are new to accounting and some of the language. And for some of those of you who are in accounting, it's just a brush up, just trying to get our language consistent across the board. So to begin, what are financial statements? There are many definitions for financial statements, but the simplest and most straightforward one are financial statements are tools that measure, record, and communicate financial information for business decision making. And that's how they're relevant to you. I don't think everyone in this room is going to be an accountant, nor do they want to be an accountant. But if you're going to be in business, there's a financial component to just about every decision that you make, whether it's budgetary constraints, things like that. So it's really important that you have financial statement literacy. So again, financial statements are, simply put, tools that measure, record, and communicate financial information for business decision making. So let's talk about what the four core financial statements are. The first one is a balance sheet. It basically gives you financial position at the end of a period. The income statement is earnings for a period. The cash flow statement demonstrates sources and uses of cash. And statement of changes in stockholders' equity indicates changes in either investor contributions or distributions during a period. Of these four financial statements, we're going to concentrate on the balance sheet and income statement at the outset of the class. But before we get into the actual financial statements themselves, I just wanted to touch on, who uses financial statements for their business decision making. We touched on this a little bit on Saturday. Owners, management, employees, those are all internal users of financial statements. And then external users, such as investors who want to invest money into a business, or creditors who want to lend money to a business, government regulators, customers occasionally have an interest in knowing about the financial position of a company. Competitors certainly have an interest in understanding how their finances of their competitors are shaping up. And occasionally everyday customers and citizens do too. And we could touch on a few examples when we're back in class. But there's a broad range of users of financial statements with a broad range of interests. So let's talk about the balance sheet first. And as you walk through these slides with me, it'd be helpful if you had that handout that we had of the financial statements for your respective company, whether it be Starbucks, Harley, or Kohl's. Keep it handy because you might refer to them as we go. The balance sheet, a couple of key takeaways. It might also be called the statement of financial position in your annual report, depending on the company. The two terms are synonymous. It is a measure of the economic resources of the entity, which we call assets, and the claims against those resources, which we call liabilities and equity. A simpler way to say that is assets are what we own, and liabilities and equity are what we owe. And I'll get to an illustrative example in a moment. Another important point is the balance sheet is as of a specific point in time, typically the company's year end, but in my previous work experience, we did balance sheets every single month and reported them every single month. And another really important thing to take away is that the fundamental accounting equation, which you're going to hear me touch on probably every class this semester, is assets equals liabilities plus equity. So let's look at an example of a balance sheet. And if you have your financials for your respective company handy, it might be worth keeping them handy and just comparing as we go. But the balance sheet, again, breaks out assets, or the resources of the entity, and liabilities and stockholders' equity, which are the claims against those resources. And as we said, assets always equal total liabilities and stockholder equity. It's a dollar for dollar match. So right now, if you have your financial statements in front of you, take a look and see if you could identify the total assets and see if you can identify the total stockholders' liabilities and stockholders' equity. The two numbers should be equal. And using this basic accounting equation, for the numbers that are left blank, you can easily back into what the numbers should be. And then you can check your work against the actual published reports on the SEC website that we looked at Saturday, or on the webpage, the investor relations webpage of the respective company. But if you can, just go ahead and identify the total assets of your company, identify the total liabilities and stockholder equity, and then see how the total liabilities and total stockholder equity add up to make up this total. But this relationship, assets equals liabilities plus stockholders' equity, is essential to understand. We're going to touch on it all semester long. So again, think of this as the resources of the entity. Think of this as the claims against those resources. So if Main Street Store were to go bankrupt tomorrow and just close up shop, they would have $320,000 worth of assets that needed to be divvied up among stockholders and creditors. So the total liabilities due to creditors, they could make a claim of $117,000 of this $320,000, and the stockholders would make a claim of $203,000 of this $320,000. So again, this is what we own and this is what we owe. If we decided to wrap up shop and liquidate and give this $320,000 back, we'd owe $117,000 of it, of liabilities to creditors, and $203,000 to investors. Another thing I also want you to notice on the balance sheet is there are certain classifications that are come in very handy when you start filling out that financial statement summary. So you'll notice there's current assets, and these are simply assets that are likely to be converted to cash or used to benefit the entity within 1 year. So within 12 calendar months of the balance sheet date, you're going to have, this will have an economic benefit to the entity. Longer term assets are generally going to benefit the entity over several years. So the easiest example of that would be equipment. So if you think about Harley Davidson and the production equipment and the line equipment that they use to manufacture motorcycles, they will use that equipment for 7 to 10 years. So there is a long period in which they buy perhaps a $40,000 bit of equipment, and then it depreciates. You'll notice here is the depreciation component ratably over that term. Another thing while we're on the balance sheet is each of your balance sheets is as of a point in time. So you'll notice for each one of the companies you're looking at, it's as of, if you look at the annual report, as of their fiscal year end. So in this particular example, the fiscal year end is apparently August 31st, 2014. And that is basically, as of this date, this is the amount of resources of the entity, and these are the claims against those resources. The balance sheet has, the liability side of the balance sheet has similar classifications. So you'll notice in each of your financial reports, there should be on your balance sheet a section called current liabilities. These are liabilities that are going to be paid within 1 year. So accounts payable, for example, if you're Starbucks, you might have accounts payable to the people who sell you the coffee beans that go into your product. You might have accrued liabilities due to management bonuses if they happen to sell a lot of coffee. You might have short-term debt. This might be the amount of debt that you have to pay within the next 12 months. And then Starbucks might also have some long-term debt. That might be the amount of debt they have to pay in 2 years, 3 years, 4 years, 5 years from now. On this slide, I'll let you go through it on your own time, but basically it's very important that you learn the language and become familiar with the accounts that are classified on the balance sheet. All right, so we have cash, accounts receivable, merchandise, each with their own definition. But you can imagine how some of these are self-explanatory, but think about if you were Kohl's. Would they have accounts receivable? So these are amounts due from customers? Probably not, just because they collect a lot of money in either cash or immediately paid through credit cards. So they may not have that in their financial statements. Harley Davidson probably does have accounts receivable. Not everyone pays for their motorcycles in cash straight up. So they might have some amounts due from customers will be collected after the sale. Inventory and equipment is self-explanatory. Accumulated depreciation we touched on. As far as the liability side, again, this is what we owe. Debt is typically owed to banks, and payables typically owed to creditors such as suppliers. The second financial statement I wanted to touch on is the income statement, and there are a few key takeaways. You'll notice in your respective companies, this is also called the statement of earnings or a profit and loss, also known as a P&L. So 3 different names for the same statement. The most important takeaway is that the formula for the income statement is very simple. Revenue minus expenses equals net income. And another way of thinking this is revenue is your accomplishment and expenses are the effort expended in attaining that accomplishment. So when you net the accomplishment versus the effort against the effort it takes to get that accomplishment, you arrive at net income. Unlike the balance sheet, which is as of a point in time, the income statement is for a period of time. So the balance sheet is as of 12/31/2013. The income statement is for the 12-month period ending 12/31/2013. In this example, you'll notice that there's a couple of subcategories. Again, it's the basic premise is net income. You arrive at it by taking revenues minus expenses. But they go through a couple of steps to arrive at gross profit, income from operations, income before taxes, and then net income. So this is kind of a stepped approach. So I would encourage you to look at your income statement to see what sort of subtotals management uses to communicate this net income information. But at the end of the day, the basic formula holds true. It's revenues minus expenses. And again, we have on this page basic examples or basic terminology that explains what some of these line items are. And we'll touch on this throughout the course of the semester. But it's really important to understand that for each dollar of sales, there's associated cost of goods for those sales. And when you net those two, you arrive at gross profit. For some of your companies, this is explicitly stated in the face of the financials. I think for Kohl's it is. So if you sell a sweater for $10 that you bought for $5, you make $5 of gross profit. If you sell a cup of coffee for $4 and the cost of those beans is $2, your gross profit is $2. Sometimes it's explicitly stated in the face of the financial statements. Other times you have to actually calculate it. Selling and general administrative expenses. So for someone like Starbucks, that would be advertising. For someone like Harley, that might include sales commissions, things of that nature. When you take selling general administrative expenses from your gross profit, you arrive at income from operations, which is a key number for investors. Taxes, I think, are self-explanatory. Interest expense is the same to you as it is to big companies. And then when you take all these expenses and you back them away from revenue, you arrive at net income. And we're also going to talk quite a bit beginning next class period on earnings per share, which is a key metric for financial statement users and particularly investors. So anyway, I hope this little voiceover on these slides helps reemphasize some of the key points, and I hope it's helpful to you as you begin digging through your financial statements for each respective company. And I'll give you one last hint if you've made it to this point in the presentation. If you go to footnote 1, which is immediately following each set of financial statements, each company usually has a description of some of these account lines. So for example, they might have a description of what falls into cash. They might have a description of what's in equipment or inventory. So give that a look. You might also find that to be helpful. Good luck, and if you have any questions as you proceed, feel free to shoot me a note or give me a call. Take care.